Cameth this week. Were you ready? The good news is that tax season is behind us. So here's something to keep in mind for the future, according to certified financial planner Howard Pressman. He says Roth accounts are a great way to build flexibility into your retirement, income planning that is. To make the most of them, however, it's best to start planning long before retirement. So I want to say welcome to Howard, and thank you for joining us today.
You're welcome, Julie. Thank you very much.
So I want to start off by asking you, what is the difference between a Roth IRA and a traditional IRA?
So that's a great question. Really, the fundamental difference is when you get the tax benefits. So with a traditional IRA, the money goes in pre-tax, so you don't pay any taxes on the money that you contribute. While the money's inside of that account, it's going to grow tax deferred. So you'll pay no taxes on any of the gains or the dividends that are paid in the account while it's in there. Now, in retirement, when you begin to pull that money out, you're going to pay taxes on all of it. Every dollar that comes out of that account, you'll pay taxes on. So when we give our retirement planning workshops, I like to ask the attendees, say you are a retiree and you want to withdraw money from your IRA to pay for something that costs $100. How much do you have to withdraw? And let's assume you're in the 33% combined federal and state tax bracket. Right. The number one answer is usually $133, but that's wrong. It's actually $150. So 33% of 150 is 50. That goes to the tax man. Mm-hmm. The rest, you get the $100 to buy what you needed. So you had to withdraw 50% more than what you needed in order to net that $100. Now with a Roth IRA, there's no tax deductions today. That money will still grow tax deferred, provided you meet the couple of rules, which are pretty easy. When you pull that money out in retirement, it all comes out tax-free.
Okay. All right. That's good to know. I did not know the difference there. Thank you. All right. Well, when you make a contribution to the traditional IRA or 401k, I understand that it's done before taxes, meaning that you usually get a tax deduction equal to your contribution. Can you give us another example of this?
Yeah. So let's say we have a person who makes $100,000 a year, and this person wisely decides to make the maximum allowable contribution of $18,000 to their 401k. Mm-hmm. For tax purposes, on their 1040, they're going to report their income as being $82,000. So it's $100,000 less the 18. You don't pay any taxes on that $18,000. All
right. I like that idea.
It's a great benefit.
It's a great benefit. Okay, so are Roth accounts good strategies for young investors?
Outstanding strategies for young investors, because number one, younger investors are usually in a lower tax bracket as they're beginning their career, and typically they'll progress, through their career. They'll get, their income will increase, their taxes will increase. Mm-hmm. So what about paying taxes at the lower tax rate today and paying less taxes in the higher tax rates in the future? Plus, with long time frames, and again, I can't overemphasize mm-hmm. The benefits of this long-term growth, but somebody in their 20s who might retire at 65 will have potentially 40, 45 years of tax-free compounded growth inside of this account. That's a huge, huge benefit.
Right.
Plus, there's some flexibility there because any contributions made to a Roth IRA can always be withdrawn tax and penalty free. So if circumstances change for somebody mm-hmm. and they find that they need quick access to money, they could take their contributions out of the Roth.
Okay, so we talked about young investors. What about someone who's closer to retirement? Is a Roth does that still make sense for someone?
It might, and that's where things get a little bit more complicated. And this is all about building flexibility, and ideally that's what we want to create for people in retirement, is the mm-hmm. flexibility to construct their income stream based on current tax laws. So one of the biggest challenges that I see is that retirees have all or most of their money inside of a traditional IRA. Every dollar that comes out, mm-hmm. they have to pay taxes on. So their Social Security, they're paying taxes. Their distributions are paying taxes. And ultimately, they've lost all control over their tax brackets. They're at the whim of the tax law. We want to create that flexibility for them to construct their income stream based on the tax laws in place. We'll have a little bit of money in the Roth, a little mm-hmm. bit of money in the traditional IRA, and then we have some flexibility to control their tax brackets. Additionally, traditional IRAs have required minimum distributions. So when you hit 70 and a half, you
right.
have to start pulling your money out of your IRA, whether you need to use it or not. Okay. Roth IRAs don't have required minimum distributions for the original account owners. So in that case, again, we have more control.
Well, Howard, before I let you go, we want to talk a little bit about the e-newsletter that you guys have.
Yep.
Can you explain that and tell me more about it?
Yeah, so my firm, Egan, Berger Weiner, we create a newsletter every month, and that newsletter really addresses what we consider to be important financial planning concepts for everybody. A lot of these ideas that we get are driven directly from our clients. And they tell us what they want to hear, and we create, and we think it's going to be of interest to a wide variety of people.
All right, Howard, thank you for joining us
My
today.
pleasure.
We
Thank you.
appreciate it. All right, again, thank you for joining us, and for more information about Egan, Berger & Weiner, LLC, visit ebwllc.com. Learn more from the company's Knowledge University at ebwfinancialnews.com. Stay with us. We have more of Let's Talk Live coming up right after the break.